At Numerian Capital, we bring you the latest stock news each day. Please like and subscribe so we can bring these articles to you each day. Thank you.
Today, December 15, 2022, Netflix stock falls as ad-supported plan reportedly misses key target. The shortfall doesn't spell great news for the consumer economy or Netflix stock. Shares of Netflix plunged nearly double digits on Thursday's afternoon session. The streaming giant's much-hyped ad-tier service plan got off to a rough start. Netflix stock may face pressure from a weaker-than-expected consumer economy. Ranking among the streaming giant's most discussed business initiatives, Netflix, Nasdaq NFLX, anticipated a new era of opportunities when it announced its advertisement-supported subscription tier. Unfortunately, the early results indicate that the enterprise has a wall to climb. Not surprisingly, then, the market punished Netflix stock, which fell nearly double digits in the afternoon session. Moreover, Netflix's poor performance implies a worse-than-expected consumer economy. According to Digiday, Netflix fell short of ad-supported viewership guarantees made to advertisers. In response, the streaming service allowed the affected companies to take their money back for ads not run. While specific shortfall amounts vary by advertiser, 5 agency executives familiar with the matter reported that in some cases, Netflix roughly delivered only 80% of the expected audience. They can't deliver. They don't have enough inventory to deliver. So they're literally giving the money back, stated one of the execs. Netflix declined to comment, but if some substance exists to the report, it bodes poorly for Netflix stock. Indeed, the higher-ups at Netflix looked forward to the release of the ad-tier plan to reinvigorate Netflix stock. In an interview for the New York Times Deal Book Summit, Netflix co-founder and co-chief executive Reed Hastings regretted not bringing the ad tier sooner. "That's the real thing that I missed," Hastings said. "We didn't have to steal away the advertising revenue, in fact, it was pouring into connected TV if the inventory is there." Unfortunately, that assessment appears to have missed the mark. Netflix stock presents a potentially worrying economic barometer. After suffering severe losses in the first half of this year, many investors looked forward to Netflix stock rebounding. Indeed, in the trailing half-year period inclusive of today's ugly downfall, shares gained roughly 60%. Still, the Thursday session risks serving as a harsh reality check. In October, Netflix stock surged by double digits as the underlying company beat expectations for its third quarter. As Investor Place's William White mentioned, not only did Netflix beat top and bottom line estimates, it also saw a return to subscriber growth. Even better for the industry, rival Disney bounced higher both in sympathy and for underlying consumer economic catalysts. Essentially, with inflation beating down household budgets, Americans started to pull back on traveling and dining out. However, against a dollar for value perspective, streaming delivers compelling entertainment for a low cost, especially compared to exotic vacations. Unfortunately, this thesis for Netflix stock appears to contrast with the reality staring down Netflix. It's possible consumers are cutting back on cheap discretionary expenditures. To be fair, the aforementioned advertising executives doesn't believe the viewership miss represents a long-term obstacle for Netflix stock. Rather, they target how quickly Netflix brought the ad-tier subscription to the public. Nevertheless, while Netflix shares dropped nearly 9% in the early afternoon session, Disney also suffered a significant market loss. On Thursday, Disney dipped around 4%. For the time being, then, traders appear to be treating this latest report as an industry-wide dilemma.
Thanks for watching Numerian Capital News. Please come back tomorrow for another stock news update. Thank you.